So the question on everybody's mind right now is whether Apple is a buy after just releasing their Q1 2022 results, and considering that the stock is up just over 4% in the pre-market, that may suggest that institutional investors certainly think so, but we don't follow what they're doing. We look at the earnings report, so we're going to go through the income statement, we're going to look at the cash flow statement, we're going to look at the balance sheet, and then from there we're going to flick across to my valuation model to see what I think the fair value of the company is and whether the stock is a buy at today's price. Now, when we're talking about Apple, we're talking about the world's largest public company, but you certainly wouldn't think that from looking at the stock chart, considering the fact that the stock is up almost 100% from its pre-COVID highs. And if you actually go to the COVID low, we're talking about a stock that has risen by 180% in just a couple of years. So that is incredible growth, but we need to know whether that is justified or not. And of course, in order to do that, we need to create our own valuation. And in order to create our own valuation, we need to understand the earnings reports. So you can see here that they actually posted revenues of $124 billion in just 3 months, which is absolutely insane. And they actually posted revenue growth of 11%, which on some very, very strong comparables, that is not too bad at all. And that actually beat analyst estimates by $5 billion. And $5 billion of revenue in 3 months would be decent for most businesses. We're talking about a business here that is beating analyst estimates by $5 billion in just 3 quarters. So that's how you really need to understand the size of this business. Now, when we dig into the composition of those revenues, we can see that $104 billion of those is driven by products and $19.5 billion of that is driven by services. And those services are things like their iCloud storage or their subscriptions and so on. Now, you compare that with a year earlier, they had $96 billion in products and they had $15.5 billion in services. So their services as a percentage is actually growing quicker than their products. And the reason why that's such a good thing is because their margins on their services are much higher than the margins on their products. And as a result of that, we'll start to see that when we come down here, their margins are actually increasing as well. So when we come down to cost of sales, we can see the most recent quarter was $69.7 billion, and compare that with a year earlier, and that was $67.1 billion. So in effect, their cost of sales went up by about $2.7 billion or $2.6 billion. Now you compare that with the fact that their revenues increased by $11 billion, and you start to see how those margins are really ticking up. That means that their gross margins have increased by almost $10 billion from $44.3 billion to $54.2 billion in the quarter. We come down to their operating expenses, and they're spending more on research and development, and that's something that I always like to see, particularly when it's a well-run business like Apple, and especially with a very good management team. You want companies to be pumping money into research and development, to be coming up with new products to then later on drive that top line revenue growth. Their selling, general and admin costs have ticked up ever so slightly, but it still only represents around 5% of their total revenues, so they're very, very efficient in their operations. That means that out of that $124 billion in revenue, their operating income is almost $42 billion, which is very, very high for any business, no matter what industry you're working in. Of course, they've got to give their share to the tax man, and after that, you're looking at a net income of $34.6 billion. You compare that to a year ago today, when it was $28.7 billion, clearly we're starting to see these margins really tick up. Now, in terms of that revenue generation by region, they're not actually growing that much in the Americas and in Europe. They're looking at around a 10% growth rate in each of those. But for Greater China, it looks like we're growing at around 18%. So that is very good, especially considering the size of the market in China. If they can continue to grow at a fast rate in China, then clearly that's going to drive overall revenue growth. Now we move down to the balance sheet, and you won't be surprised to hear that there's absolutely no concern from a financial health perspective for the world's largest public company. We're talking about a company that has cash and cash equivalents of $37 billion. And then they've also got some marketable securities, so treasury bonds, for example, of almost $27 billion. So there's absolutely no concern. And actually, they've got so much cash that they need to really be putting this to use and investing that in different avenues, particularly in this high interest rate environment, where if they just leave that cash and cash equivalents here sitting in the bank, then they're losing about 7% of that value year over year. With that being said, they shouldn't rush into making an acquisition just for the sake of it, but I wouldn't be surprised if I did see Apple making some moves on this cash balance here. Clearly, they are trying to offset that inflation with some marketable securities, but they've got more cash in the bank than they do marketable securities. And I do think that over time, we might see that change. Now, despite all of that cash that they do have some debt on the balance sheet, which I personally like, especially considering the current environment that we're in. So they've got around $11.1 billion worth of short-term debt. So that is due within the next year. And then if we come down and we see the long-term debt here of $106 billion, they're looking at almost $120 billion worth of debt, which people might consider as a lot, but considering the fact that actually they've got about half of that in effectively cash, it's certainly not a problem. And so long as they can continue to make the correct investments within the business, which earns a return greater than the amount of interest that they're paying on this debt, then I'm happy for them to leave that debt on the balance sheet. Then you come down to the cash flow statement, and remember we had net income from above of $34.6 billion. We make some adjustments for some non-cash expenses, so we're talking about depreciation and amortization, some stock-based compensation as well. We get down to here of cash generated by operating activities of just under $47 billion. You compare that with a year earlier and we were talking about $38.7 billion, so clearly there's been a massive swing there. You then take that $47 billion of cash generated from operating activities and you subtract your capital expenditures to get your free cash flow. Now there's a massive amount of free cash flow being generated by this business. In terms of what else they're doing with their cash, well, they've purchased some multiple securities, which we saw above. And then it looks like they've actually changed the debt structure ever so slightly as well, because we can see here proceeds from maturities of multiple securities and then proceeds from sale of multiple securities as well. That means that out of that $47 billion of cash that they used, they spent $16 billion of that investing in the business. We come further down and we look at their financing activities, we can see that they actually repurchased $20 billion worth of stock, and effectively they're distributing this capital to shareholders by doing that. And not only are they doing that, they're also paying dividends as well of $3.7 billion, and that's just for the quarter. So from an operational perspective, this business looks to be doing all of the right things and ticking all of the right boxes. So then that brings me on to my valuation model for the business. Now there's absolutely no doubt whatsoever that Apple have had a phenomenal year, and as a result of that, the stock price has increased as well. So we can see that for 2021, they put in revenue growth of 33%. And if we actually go further back, right, the year prior to that was only 5.5%. The year prior to that, they actually fell. Their revenue declined by 2%. And then the year prior to that, it was sitting at 16%. In my model going forward, I'm expecting 1 to 5 year revenue growth to actually sit at around 9% per year. Now, some people are going to say, well, that's far too low. And I would actually counter that with the fact that if you go to analyst estimates for 2022, we're only expecting 4.4% revenue growth. And for 2023, we're only looking at 6% revenue growth, according to the analyst estimate consensus. Now, considering the fact that they've just put in a very strong quarter with a revenue growth of 11%, I'm going to give them the benefit of the doubt, and I'm actually going to say that they're going to be able to maintain revenue growth of 9% for the next 5 years. That is then going to decline slightly to 7.5%. I think that they'll always be able to retain this pricing power that they have just because of how good their brand is. But there's, it's clear to see that they are sort of saturating or reaching a saturated market. And you have to question how much more that they can actually grow. That means that their revenues are going to increase from $366 billion in 2021 all the way up to $808 billion in 2031. So despite the fact that those percentage increases look relatively small, when you actually look at it over a 10-year horizon, we're talking about a huge amount of growth here, considering how saturated the market appears to be. So what am I expecting to be the drivers of that growth? Well, I think that their hardware will continue to grow, but I think that their services will continue to grow at a faster rate as well. And I think that over a 10-year period, that will become a key driver for revenue growth in the business. Now, in terms of gross margins, we've just saw in the most recent quarter that Apple are really flexing their pricing power. And as a result of that, their gross margins actually increased up to 43%. Now, in my model, I'm expecting that to continue to increase right the way up to 46%, where I think that they will eventually plateau. Now, in terms of operating expenses as a percentage of revenue, now this has remained relatively flat across the period. We're talking about an average of 12.5%. I've left that at 12% throughout the entirety of my model. After we take into consideration some other income as well as some taxes, that leaves us with a net profit margin for 2022 of 26.7%. Now you compare that with 2021 of 25.9%, so we're seeing a slight uptick there. By the time we get to around 2026, I'm expecting that net income margin to effectively plateau at around 29.3%. Now, once again, there aren't many businesses in the world that can produce net income margins of 29.3%, never mind whilst at the same time achieving revenues of $562 billion. So you have to give a lot of credit to this business. That means that by the end of the 10-year period, we're talking about net incomes over here of $236 billion on $808 billion of revenue, which is absolutely phenomenal. We move across to the discounted cash flow, and I do this based on unlevered free cash flow. So we start at EBITDA. Now, the EBITDA margins over the last 5 years have been around 30%. But we see in 2021 that obviously increased quite significantly due to their increased gross margins. Now, in my model, I'm expecting for 2022 to sit at 34%, followed by 35%, and a further increase to 36%, where I think that we'll pretty much hit a plateau at that point. Unlevered free cash flow as a percentage of EBITDA. Now, I've taken that of the average of the last 4 years, and I've excluded this anomalous result here. And as a result of that, we're looking at around 84%. Now, in terms of what that means for a fair value for the business, well, we look at discounted cash flow and we're talking about an intrinsic value per share of just $127. You move down to the multiple of earnings, and I've done this based on a PE ratio of 18 in 10 years time, and I'll explain that in a moment. We're looking at a price per share in 10 years of around $274, which today is worth around $104 for the weighted average cost of capital return. That means that we're looking at a fair value per share of just $115, suggesting that actually this is a negative margin of safety. In other words, the company is around 30% overvalued at the current price. Now, in terms of using a PE ratio of 18 in 10 years time, well, you have to remember that in my model, I've suggested that from years 6 to 10, I'm expecting revenue growth to sit at only 7.5%. As a result of that, this is not a fast growing business, and therefore people aren't going to be willing, generally speaking, to pay a significantly higher multiple for that business. But of course, in today's market, everybody thinks that you should be applying a PE ratio of 50 to a company in 10 years time. Well, those people are going to get a significant reality check. If you look actually back as well to the chart here, we can see that if we take out the noise from COVID, because once again, valuations have run absolutely crazy over the last 2 years. Before that, we saw PE ratios as low as 11 for Apple. And actually, if you go back further, the average does sit at somewhere between 16 and 18. And actually, as a result of that, I think that 18 is probably fair. If anything, it might be slightly too high considering the fact that by that point, the business is not going to be growing all that much. That is, of course, unless they do manage to venture into a load of new industries such as the Apple car and things like that. But at the moment, all of that is so early on that it's not even worth incorporating into your model. Because if you do, then you're just betting on a pipe dream, and that's not how you should be valuing companies. So then we come on to my 2026 price target, because just because a value is currently overvalued, it doesn't necessarily mean that you're not going to see a return at all on your investment. Now, this is based on an enterprise value to EBITDA multiple, and we can see that we've got 2026 EBITDA of $197 billion. We've got an enterprise value to EBITDA multiple of 16. And once again, I'll justify that in a moment. That brings us to a 2026 price target after taking into consideration share buybacks, as well as a dividend of $194, which would be a total return of just 4.1% per year, which, it goes without saying, isn't going to outperform the market in an average year. So what's the rationale for using an enterprise value to EBITDA multiple of 16 in 5 years time, despite that at the moment it sits at something like 22? Well, it's really quite simple. When valuations normalize and when the valuations revert to the mean, I expect the valuation multiples that people are willing to pay to be a lot lower. If we go back once again prior to COVID, we can see that it did see highs of somewhere around 17. But actually before that, it's been as low as 7, which is crazy, by the way. But on average, it was sitting at around 10 or 11. I think that I'm being more than generous when I apply an enterprise value to EBITDA multiple of 16 for this type of business into the future. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.